Good afternoon, everyone. Peter, can you hear me?
Yes, I can. Okay, good afternoon, everyone, and welcome to this webinar being hosted by Green Life Industry Australia on the establishment of a discretionary mutual fund and group purchasing program. We're expecting around 30 people to join the webinar today. So we'll just add a couple of minutes to allow people to join until we get into it. I will do some basic sort of overview of the webinar and some details on how it will be conducted, and then hand over to Justin Niven, who you can see on the screen as well, and Justin will be providing the presentation. So I'll just check to see how many numbers that we have. We're up to 13, so I'll just give a minute more and then we'll kick into it. Any comments you'd like to add, Sonia, at this stage?
No, just to identify that there is a chat box down in your access area, and if you have any questions while we're going through, I'm going to field those questions to Justin. So if they're urgent, then and we'll stop at a particular place and we'll go through that question and Justin can answer the questions, or alternatively we can leave the questioning until the end of the presentation.
Okay, thanks for that, Sonia. Given it's 12:04, we'll kick off the webinar now. So welcome everyone to this Green Life Industry Australia hosted webinar on insurance option for the industry. The presentation will cover the discretionary mutual fund and group purchasing program for the nursery industry across the country. Sonia and I have been working on this, Sonia in particular, around looking at insurance options for the industry for over a year now. It has been highlighted it's a significant issue for the industry. We've had a couple of approaches to get information to determine whether there's the viability to then progress to a feasibility study to work out whether we can progress with a DMF. The presentation today will be delivered by Justin Niven, who's the Managing Director of KJ Risk Group, and joining Justin today is Alan Lempier, who's the Business Development Manager for AB Phillips. Sonia has been in extensive contact with Justin and Alan over the year, and one of the aim of this webinar is to provide an overview of a DMF and then take questions. So Sonia, as she said, will be watching the chat box, which is in the right-hand side of the screen. Well, that's where it is on my screen. So hopefully you'll be able to find that, and we'll field those questions, and Sonia will manage them as we go through. So I'd just like to hand over to Justin, who will take us through his presentation, and then we'll have the chance for the Q&A and chat after that. Thank you, Justin.
Thank you very much for the introduction. I'm hoping that everybody can see the PowerPoint that we have up on the screen today. As mentioned, I'll run through at a high level what a discretionary mutual fund is, and then tie that back to what it can potentially do for your industry. Thank you again for the introduction. A little bit more about me at a high level. I've been in insurance for over 20 years, and I've been involved in mutual for 18 of those years. I set up my own business in 2010, having worked at a large company called Marsh, who some of you may be familiar with before that. My biggest client is McDonald's. So every McDonald's restaurant that you see in Australia and New Zealand, they're all part of a mutual. They've had that for over 20 years, and it's been unbelievably successful for them because for all intents and purposes, they've lifted themselves out of the insurance market. We'll talk a little bit later about what you're experiencing with regard to pricing and reduction in cover, but at a high level, being self-insured, you have more control over both of those outcomes. There are some numbers there on the screen. just to highlight that these mutuals can cover very, large amounts of assets and turnover. Obviously, McDonald's is a big business, and so the more scale that you have, generally speaking, the more successful the mutual is. They don't work if they're too small, because in essence, you're setting up a small insurance company, and so you've got fixed costs that need to be covered in that equation. And so with more scale comes obviously more benefit and more risk sharing. We've also kindly introduced Alan from AB Phillips, who you can see on the screen there. Alan and I have been working together for quite some time now, trying to bring mutuals to the agricultural industry in particular, because we feel that there's a natural sort of connection there. You guys do a lot of things together as a group anyway, and there's a lot of cooperation, and so sharing each other's risks seems like a natural extension of that. And Alan and David Keys are the two key people from AB Phillips attached to this project. So jumping into it, at a very high level, a feasibility involves these following steps. Firstly, we would get an external lawyer to do a legal review of the proposed structure. We would get a tax advisor to tell us, do we tick the box and can we access all the tax benefits? I'll cover off what those are in a minute, a future slide. Really the place we need to start though is the risk data analysis. What that involves is collecting information from all of you and your businesses on your premiums and claims, as well as the assets, the things that you own and where those assets are. That lets us put all of that data together and actually see what it looks like as a combined group. By way of example, we completed a study for another agricultural sector. We only collected data from 12% of the group, but in that 12% of the group, we had property premiums in excess of $6 million, and they were only claiming $1.2 million a year in actual claims. So very big variance between what they're cumulatively paying to insurers, lots of different insurers, and what they're actually claiming. And that's a really important point in a mutual structure is, there'll be a variance between what you're paying and claiming, and we want to try to capture some of that and return that to you. That's your profit. So in simple terms, that's what a mutual is trying to do. The risk data analysis will reveal, what the opportunity is once we collate all of it, but it also then helps us have the conversation with insurers to find people that want to help support the structure. And that's obviously a critical part of it. You don't want to put all of your risk into a mutual. There will still be some exposures that are better dealt with, using insurance. We're just going to buy less insurance. So again, we should have more control over it. Once we get positive outcomes to all of those 4 steps, we can obviously tie that up in a formal feasibility study report, and then hopefully implement the mutual and move forward. So just a little bit on risk. Ostensibly, a DMF is a financial vehicle for the management of risk. It's owned and operated by its members. So we would establish the mutual as a company limited by guarantee. So there aren't any shares per se, but the owners of the mutual are your entities. So the members who actually sign up to be covered by the mutual technically own it. They're about sharing risk. We definitely want to leverage economies of scale. The bigger, the better, generally speaking. But one of the great things about it is I've found that it leads to more risk ownership. That's not to suggest that you don't own your risk now, but I found that it does change the equation when you all contribute money together into a pool, and that's what you're claiming from. Businesses then possibly work harder to avoid any and all claims because you're profiting from it, and insurer isn't profiting from it, you are. And so you can actually really maximize risk management outcomes with a mutual structure. This graph in the top right's the bit to look at. I'll run it through with you quite quickly. The light blue wedge is the deductible that you might have. So if we take property as an example, you might have a $10,000 deductible on any one claim that you have. The dark blue layer is what we call the working layer of risk. That's where lots of smaller claims occur. And then the green layer is what we call the catastrophic layer of risk. That's where things like bushfires or other large natural catastrophes occur. Your insurance contract doesn't cover the deductible, obviously, but it covers the working layer and the primary layer. And then the other part of the pie is obviously uninsurable risk, because there are things which are simply uneconomical to insure. A case in point is business interruption insurance triggered by COVID. There's no way an insurer could possibly write that cover. They would be bankrupt if they did. So that's an example of an uninsurable risk. So why am I telling you this? Because the key point of a mutual in this dark grey segment here is to capture and manage your working layer of risk. We don't want to touch the catastrophic risk because the dollars are too big. We want to use insurance for that, but we want to take the working layer into the mutual and manage that ourselves. That's going to give us better control of claims, better control of pricing, and coverage as well, because this is a self-insurance vehicle in simple terms. What does a retention structure look like and how does it work? This aggregate here is an amount of money that you would all cumulatively pull together in any 1 year. So let's say, for example, that's $4 million you pull together, and that's to pay all of your property losses in any 1 year. We still have insurance that sits both above and beside that aggregate. Along the axes here, we've got the accumulation of losses. So what that means is when total losses exceed $4 million, the insurer steps in and pays all other claims from the ground up. So there's a certainty that the claims will always get paid. But obviously, we want the claims to be within the aggregate, and if they are, that means that we've made you a profit. This axis is called value per loss, and so you might have what we call a stop loss in there of, say, $2 million. That's designed to protect you if there's a large event, say there's a bushfire. Only $2 million of losses relating to that bushfire would go into the mutual. The rest of it would be paid for by insurance, thus protecting your money. This slide here shows what we hope to achieve. So in the example I used before of another agricultural segment, their differential between premium and claims was enormous. And so if we put a mutual in place for them, they would, on paper anyway, be running a healthy surplus every year. So I'll touch on what surpluses are and how they can be utilized for members in a later slide, but basically think about that as profit. So what we've done is, rather than buying an insurance contract where 100% of the money goes to the insurer and you never see it again, we're taking a big chunk of it, putting it into a mutual, and then managing that money for you. And hopefully we get the numbers right. The claims are less than that pool, generating a profit back to you. This graph is for illustrative purposes only, but you know, we're somewhere in this part of the market cycle at the moment. As you would have all been experiencing, premiums have been going through the roof and have been rising astronomically now for a couple of years. This year in particular, the momentum's picked up a lot. A lot of people ask, you know, when will it turn? That's the $64,000 question. It's very hard to pick it. A lot of people think we're getting close to the top of that, but with the fact that we're still continually being disrupted by COVID and the world doesn't seem to be, you know, getting over it as quickly as we initially thought, I could see it still rising for some time. Economic conditions aren't that great. So the point of this graph is to show you that the XOL premium, so XOL stands for excess of loss insurance. If you think back to a page ago, we had excess of loss insurance sitting above and beside the mutual to protect it. Excess of loss insurance is less volatile than traditional ground up insurance because you're covering a fundamentally different risk. You're covering catastrophic risk, you're not covering every day-to-day risk. And so thus you have less volatility, you don't have the same movements in price. You certainly still have price increases, don't get me wrong, they're just not as volatile as being in the market ground up.
So Justin, it's Peter here, just on that, has there been that sort of volatility over the decades as well? Like, if you went back further, would you see that volatility given other circumstances as well?
Yes, absolutely. The last time we had a hard insurance market, I would suggest was around 9/11. When 9/11 happened, they actually halted trading on QBE stocks because their stocks fell through the floor. That hardened property markets around the world. We'd never had to deal with terrorism before as an issue, and that significantly hardened markets at that time. What we're experiencing now, though, in my opinion, and at least in the 20 years that I've been around, I've never seen it. We're seeing hardening across multiple lines of insurance very, very broadly. So, you know, if you're in construction, getting professional indemnity insurance for construction is very problematic. Liability markets are tightening, property markets. So this isn't good news, obviously, for business owners, but it's also because of those rising prices that it makes a mutual more appetizing. Ultimately, it's a good time to do it, so you can try to lift yourself out of those market cycles and control your own destiny. I can't reveal too much detail about the McDonald's program for obvious reasons, but what I can tell you is that on a dollar for dollar basis, unadjusted for inflation, they're paying less today than they were paying 20 years ago, even though their business has tripled. The reason for that, it's an amazing outcome. The reason for that is because in a mutual, what you claim, you pay. It's a self-insurance model, so you don't need to have an insurer's profit margin. You can deal with your risk exactly as it presents itself. You don't have an insurer telling you, you know, your exposure to bushfire is something when in fact it's another thing altogether. So you've got incredible control over your own pricing over time. It's very important, obviously, for us to find insurer partners to partner with as excess of loss providers. There are obviously some risks that your industry face that insurers don't like, including EPS, paneling on cold storage. But again, in a mutual, you can access markets and hopefully find a solution for those hard to place risks. So a little bit of a Q&A on DMFs, some more information about them. I mentioned before that DMFs are very tax effective. The first reason why is because we can apply a thing called the principle of mutuality. The principle of mutuality means you can't derive income from yourself. So if you are a grower and your entity is a member of the mutual, then you technically own the mutual. So when you put money into it, it's not taxable. Obviously a huge advantage. As important is the fact that because it's not insurance, it doesn't attract insurance statutory charges for growers in New South Wales that will be used to seeing pretty big tax charges on their property insurance, which is FSL and stamp duty. Those taxes do not apply in a mutual scenario. So there are certainly significant cost savings or advantages to having a mutual simply for that reason alone. In my opinion, you don't go into a mutual for tax purposes. You do it because it's the right thing to do for your risk, but it's nice to know that it's a highly tax effective structure. Another point to make, not on the slide as well, a mutual only has the obligation to establish the aggregate each year. So if we refer to my prior example, you know, we want to put a pool together of $4 million. We only need to collect that $4 million, obviously the running costs as well, but that's it. An insurer has to hold an amount of other capital in reserve, and that's why DMFs are so much more efficient and effective in managing risk than an insurer, because you don't have to hold the additional capital reserves that insurers are required to hold. I also just want to touch on the point about DMFs not being insurance and just make sure that I've made that clear, because it's an important point to make. In an insurance contract, you get a promise or a guarantee of an indemnity. I crash my car and the insurer promises that they will repair it. In a mutual contract, there is no promise of indemnity. There's a promise that the claim will be considered. Now, that sounds scary, but it's not. As I'll touch on, there's a board composition. To be a true mutual, the board has to be majority controlled by its members. So you will determine your own claims, is what that means. Discretion actually gives you more flexibility. You can pay claims that otherwise may not be covered by the insurance contract. I've found in practice with McDonald's, that's what they've done. It's their money at the end of the day, and they oftentimes pay more than the insurance contract suggests because it's their business. And so what I mean there really as a point is, to be a true mutual, it's owned and operated by members. Obviously, Alan and myself are there to help guide the whole business, and it needs to operate on my license, my company's license, so we're there to help. But fundamentally, you'll make the decisions for your own industry and your own outcomes, which I think is a really great thing. You get to control it. Just touching on bank lending, this is a really important aspect. Because it's not insurance and because there's no guarantee of an indemnity, we really can't have 100% mutualized offering for you, because you're still going to have to be able to get finance from banks. You're still going to have to be able to evidence that your assets are covered by insurance. So we still have insurance. If you remember the graph that I had up earlier, we've got excess of loss insurance. So banks are satisfied with that model. This is the McDonald's model in action. It's the same model I'm proposing for you. And it's perfectly sound. I've dealt with the credit departments of banks over the years, and they have no issue with this model. So we'll still be able to issue certificates of currency evidencing that you have insurance in place over your operations. I've touched on board membership, board composition. I don't think I need to go back over that. Claim process. This is just an important one to pause on for a moment. As I mentioned before, a mutual is like setting up a small insurer. It's not insurance, but it acts like it. And so you would appoint a claims manager. That claims manager would be delegated with authority, and typically they would handle 99% of all claims. Those other claims that perhaps become the exceptions can be dealt with at board level, and sometimes the board makes a discretionary decision in that setting over that claim, or perhaps that claim was denied and somebody doesn't agree with that decision. They have a right to appeal to the board and have the board reconsider their claim. So that would be the first step in the process if there was a denial. If the board upheld the denial,
Justin, just to jump in there.
Yeah.
You're talking about the board as far as the DMF board. You're not talking about the GAA board. Is that correct?
Correct. The DMF board. Yes. So if we had a claim denial at the claim management level and then the board reviewed it and still didn't think it was a claim, the member still has a right to go to AFCA, which is a government body that hears financial disputes, and then that decision is obviously the end point of that. I don't see this though in practice because again, you're managing and paying your own claims. And so I've found that this really isn't needed. Usually it goes up to the board level and it's resolved at board level. Certainly no McDonald's claim has ever gone external from within their own system. But I thought I would explain that for everybody's benefit. Sorry, just touching on claims as well, we would still utilize third-party assessors. There are assessors in the market who are specialists in agriculture and at, properly assessing losses associated with your businesses. Crawford's, for example, are one of the world's biggest loss adjusters, and they've got a very strong agricultural division. So part of the claims management process is obviously finding the right supplier to utilize in that claim to assess it and make sure that it's paid properly. Surplus funds, something we certainly hope to have in the mutual. As if you remember the prior slide, that's when we turn a profit in the aggregate, when our claims are less than the aggregate amount. The DMF board can basically do whatever it likes with that money, full discretion over how it's used. Obviously, we've got some options there on the screen. It can be invested in risk management for the group. You can reduce costs, everybody likes that. You can also use it to smooth costs. I've seen this in practice with the McDonald's Mutual. They've absorbed cost increases on behalf of the group because of the retained earnings that they had. They could afford to do that. Invest in technology or otherwise retain it because, there's obviously rainy days and it's wise to obviously put some of those retained earnings away and build the financial strength of the mutual up. We would have a central administration team, a single point of contact for everybody to manage both mutual membership and all the queries to make sure that the traffic was directed to the right area, whether that be the claims department or the broking team with Alan. And so that makes it, very straightforward, both from an administrative point of view, but more importantly, from your point of view, there's a single point of contact and you just come through that point of contact to access anything that you need. So next steps, what would the key next steps be? Really got to determine if it's feasible. The risk data collection is the first part of that. And then once we review the risk data and then we see whether the opportunity has presented itself, conduct a formal feasibility study. Hopefully we get a tick on that. What we would then do is come back to the membership group and just reconfirm that everybody's still committed to it. And then we would complete negotiations with the insurer. There would be a final round of financial modelling to look at what all of the costs ultimately look like, the final deal. And then if all of those steps are ticked off, we would then implement and create the mutual. So it would be up and operating. People often ask me, how long does this take? And it's really complex, particularly when you're trying to do something for the first time. These programs don't exist. And this stage here with the XOL insurer can be one of the most problematic, but I think we just focus on the first step, which is really data collection to try and establish if this is a real opportunity for you. And best case scenario is I could actually complete all of these steps in probably 4 to 6 weeks if everything went right, but more realistically, it's a 3 to 6 month proposition, I think, collecting data, analyzing it, and negotiating with insurers. Sorry, just jumping ahead. You might ask yourself, okay, what covers would the mutual typically provide and what happens with all of my other insurance? DMFs are built on the concept of group purchasing. And so the idea would be to reconstruct the rest of your programs around group purchasing. What do I mean by that? We're trying to benefit from economies of scale of aggregating all of your spend, and then we take that by class. So whether that be motor vehicle or travel is a bad example because none of us are traveling right now, but management liability, which would have your directors and officers cover, fidelity, employment practices liability, those types of covers, and put it all with one insurer. And it can be done a couple of different ways. You can have one master policy that everybody shares, or you can have a scheme arrangement where everybody has an individual policy, but it's with one insurer, and we've done the best possible deal for everybody. And you've all got really good cover because we've obviously used that buying power to our advantage. So in my head, without having seen the data, you would look to mutualize property liability, machinery breakdown, ideally, and crop as a future point. There's, as you guys would be well aware, all sorts of issues with crop insurance and how that is, distributed and priced. So I think we park that for another day. But obviously, once you have a self-insurance vehicle, you can put whatever you like in it as long as it's financially feasible. So we can extend cover or add new covers at any point in time. The key thing is launching it and getting it off the ground. And the property insurance premiums will be the biggest premiums you pay collectively, and that will be where we get the scale to launch. But other types of insurance, which you would hopefully have, management liability is very important, motor, cyber, travel, they can all be group purchased, and therefore we can derive a greater outcome for you. I did mention on this slide as well, workers' compensation. For those of you who are in WA, ACT, Tasmania, or NT, those are underwritten states for workers' compensation where brokers can negotiate on your behalf. We run group purchasing programs in those states for McDonald's, for example, and they run unbelievably well. It's as close to being self-insured as you can get in those areas, and we would look to try to arrange workers' compensation in a similar way. I don't want to obviously cloud the conversation. We're focused on the mutual here first and foremost, but I did want to share that with you because you may have wondered, what about all of the other covers? How would we deal with those? The short answer is we need to maximize the economies of scale, leverage them with insurers and group purchasing arrangements. I've touched on that one, got ahead of myself. That's the end of the presentation thus far, and I'm happy to take any questions from the group.
Get off mute. Great, thanks for that,
Okay,
Justin.
we'll just wait on some questions.
And I'll throw to, sorry, Sonia, I'll throw to you to see if there's any questions that are coming through.
So far, we don't have any questions. So I just wanted to ask a question of myself. So in a nutshell, the DMF is run by the industry for the industry specific insurances. So you have your normal property, vehicle, machinery insurances, and then you have those hard to insure items like greenhouses, glass houses, and your normal extreme weather conditions, fire, floods, and things like that. And so a DMF is able to insure all the different, I suppose you could call them idiosyncrasies of the industry under one particular policy that's sectioned out in order to see specifically what you're getting. So you can value like for like, I suppose, because that's how I look at my insurance. If I get a new quote for insurance, I go like for like. I don't want to see what I'm getting like for like.
Yeah, absolutely correct. It will be executed a little differently unless we convince one of the current farm pack insurers to work with us, in which case you could, conceivably mutualize an entire farm pack. You can mutualize any risk that you can buy XOL cover for. As long as you can buy XOL cover, you can put it into a mutual. So I think we would obviously get to determining that as we move through the XOL negotiation phase of both feasibility, but then when we look to reconfirm it. But you're absolutely correct, and that like-for-like comparison is really important. Just while we're on that topic, I just wanted to return to something that Peter and I were talking about before we started, and just wanting to recap it for you. Obviously, as an industry, you're experiencing two whammies at the moment. One is increasing price and one is reducing cover. And that's that insurance market cycle that I showed you on the slide. And unfortunately, that's a ride that you're attached to and don't have control over. And certainly a frustrating aspect of all of that is not having transparency into your pricing and understanding where the price actually comes from and how it's derived, and why a grower up the road has a price and why I have another one. One of the goals of the DMF is to remove that, so it's not a black box anymore, so you can actually understand how your premium is derived. Without going into too much detail, Alan and I are in the process of working with an underwriter to perform that function for the mutual, whereby they have a model which basically looks at, say, 100 data points on your risk. What we want from them is for them to actually let us see inside the black box, so that we can go to a grower and say, here are the 12 things that were highlighted in that underwriting model as being high risk. And so that actually then gives you a risk management plan, but it also gives you an understanding as to why the price is what it is. What does that also mean? That ties back into growers being rewarded for investing in risk management, because the model can actually identify what you're doing and how you're doing it. You've also got a pathway to lowering your costs by improving your risk management. And I think that's all any business owner would ask for, really, to understand how their price is derived and also be told, you know, how can I move that needle? How can I impact it? Obviously, coming back to the question of the overall price and the reduction in cover, buying as a group will give you more buying power fundamentally. So we can go to an XOL insurer, and if we've got a really big premium, we're going to get their attention. We've got more negotiating power. So just coming back to pricing, and I'll wrap this point up, the mutual board determines everything. So it's a blank sheet of paper. So you as an industry get to determine how your pricing model works. Obviously, we're working with the underwriter to determine the individual pricing within, but the board still has control, or some control, over how that is derived. And as I say, we want that to reflect risk management outcomes, so we can encourage people to improve their practices.
Yeah, and Justin, it's Peter here. You talked about needing, a certain amount of data to conduct the feasibility study. Do you need a percent of businesses, or a certain number of businesses, or a certain value of production by businesses to determine the feasibility is going to work?
Yeah, that's a really good question. It's hard to answer that without seeing some of the data itself, but I'll perhaps answer that a different way. Unless we're talking about millions of dollars of premium cumulatively, the mutual really won't work. As I mentioned before, there are fixed costs of running these things, you know, audit, actuary, management costs, licensing, claims management. There are a lot of fixed and variable expenses. So without a certain amount of scale, it just doesn't make economic sense for you to do it. So the answer is probably in that premium dollar collected through the data collection phase more than anything.
Okay, thanks.
Justin, it's Karen here. Just a question on what is the minimum to get this off the ground? Or is that what you're looking at the data for?
Yeah, definitely. That's what we're looking at the data for. So it's hard to say without seeing it exactly, but as a rough guide, $3 million is perhaps line ball in terms of total premium. What I need to be able to ascertain as well is what the claims are that attach to that. So as I mentioned before, 12% of a different industry had, around 6 million in premium, but they were only claiming 1.2 million. Let's say, for example, we find a similar relationship exists, and perhaps we get to 3 or 3.5 million of premium, and you're only claiming $500,000 or $800,000 as a group. That's a very viable proposition, because there's a big difference between what you're claiming and what you're paying. So I'm really interested to see what your claims data actually looks like and what the size of that opportunity is, because as I mentioned before, in a nutshell, what we're trying to do is take a big chunk of that money and put it into the mutual so you can profit from it. Short answer, I think we need to be above 3 million.
Justin.
You're on mute, Sonia.
Sorry, just it looks like there aren't any questions at the moment, so the floor's open. If anybody has a question, please type it in and we can answer that question directly. Sort of people understanding what has been presented, we do have a recording of this and we will be putting this up on the website. Justin will also provide you with contact details for people to contact either Justin and Alan in relation to the feasibility study and assessing that risk, because that is obviously, as Justin said, something that is very important to keep the process going. But no, we don't have any questions. So Peter, I'll hand to you.
Okay, thanks, Sonia. And we'll wrap the webinar up there. So thanks, Justin and Alan, for joining us for presenting the presentation today on the discretionary mutual fund. Very informative and very detailed, and you know, there's some technical aspects that I'm certain people need additional information on. As I indicated at the beginning of the webinar, we've been pursuing this for over a year. And in my previous meeting to this, I was with the state executives, and there's certainly in principle support for us to continue to progress this. It's how we can engage best with the industry representatives to, you know, one complete a satisfactory feasibility study to determine whether we should progress. So thank you again, Justin and Alan. Thank you, Sonia, for coordinating and managing the webinar, and thank you everyone for attending. And if you have any additional questions, please contact Sonia and I in the first instance. So thank you, everyone.
Thank you.